Hello and welcome to lesson number 3, which today is focused on liquidity and how that acts as the other side of the equation of price movement. As I've repeated over the last couple of lessons, there are two main participants in the market: bank dealing desks and market makers. And in the last lesson we talked about the dealing desks and how they're responsible for moving prices with real orders and real exchanges of one currency for another, and how their activity produces the telltale patterns in individual currency strengths that we can exploit. And as I said in that lesson, individual strength and weakness is our most important and effective tool by far. It's the most powerful strategy we have, and you can trade successfully using just that by itself. But one of the great things about Forex is the amount of additional information available to us that we can use to increase our edge and our profitability. With so much extra information, we may as well take advantage of it. And one of the extra pieces of information we can use is liquidity, which really means looking at market maker activity. Now, just quickly think back to lesson 1, where I explained the distinction between bank dealing desks and market makers. Bank dealing desks are pretty much traders like you and I, in the sense that they buy and sell currencies on the customer side. They're not actually speculating like we do. They make their money through commissions and fees, but the way they execute orders is the same way that we do. They are customers. Market makers are the middleman. It's their job to take the other side of the customer orders, and the service they provide is called providing liquidity or making a market, which is where they get their name from. And that's what we're going to analyze in this lesson. Just as a quick point of interest and a clarification before we move on, market makers can be banks. In fact, most market makers are banks, but they're a different branch with a different business model. A bank can actually have 3 separate functions. They have a dealing desk, a market maker division, and a speculating desk, and they are all separate enterprises with different objectives and different ways of operating. The dealing desk is the biggest section, and that's usually a huge office floor with hundreds of traders doing what I explained in the last lesson, executing transactions on behalf of customers. The market maker section, usually that's just down in the basement. It's largely automated and it's run by computer algorithms with just 1 or 2 humans overseeing it. And the speculating section is usually the smallest desk on a separate floor, and that's got traders betting on the direction of price, just like you and I. So banks do everything, but they are separate functions, and the only thing you need to actually remember and be interested in are the 2 main activities of dealing desks and market making. It's not so much who the market maker or the dealing desk is, but how they operate that's important. It's how they participate in the market that gives us different opportunities. A market maker is a service provider, and without them we couldn't trade. Anytime you or anyone else wants to buy or sell a currency, there has to be someone to buy or sell with. There has to be someone on the other side of your transaction. Just imagine if you wanted to buy Japanese yen and you had to go looking for someone that was willing to sell them to you. You'd have to announce your intentions to the whole world, effectively go around saying, I would like to buy X amount of yen. Is there anyone out there who happens to have that amount and would be willing to sell them to me? And if so, how much will you charge me? And if you stop and think about that, it'd be pretty impractical and inconvenient. In fact, it would be totally impossible and prohibitive for most of us. And even if you did find someone to trade with, you then have a trust issue. Can you trust them to do the deal? Market makers remove all of that hassle and uncertainty and make trading nice and easy and convenient. They've set up shop and announced to the whole world that they are willing to buy and sell with anyone who wants to, and that is convenient for everyone. Buyers know exactly where to go when they want to buy, sellers know exactly where they want to go if they need to sell. And not only do we know where to go, but we also know that we can always find a willing counterparty to do the deal with us. That is, in its simplest terms, what a market maker does. They agree to buy from anyone and sell to anyone. They provide us as customers with convenience and immediacy. We can trade any time of the day or night because market makers are open 24 hours a day. Of course, they don't provide that convenient service out of the goodness of their hearts for free. They're a business and they are there to make money, and the way they do that is via the spread. They always quote 2 different prices: the price they're willing to buy and the price they're willing to sell. And you'll notice that they always buy low and sell high. Compare that though to what we and other customers trade. When we want to buy, we buy at the high price and the market maker is offering to sell at, and then we want to sell, we sell at the low price that the market maker is stating that they're prepared to buy at. So we buy high and sell low. If we were to open and then immediately close a trade before the price actually changes, we would instantly make a loss, that transaction cost, the spread. If a market maker, on the other hand, was to do the same thing, they instantly make a profit. And that's exactly what they want. That is their business model. We want the market to move. Market makers would actually prefer it if it didn't move, because that's how they make the easiest money. For us, the spread is the cost of doing business. And it's a small price to pay for the incredible convenience that market makers provide. For market makers, the spread is their profit margin, and it's tiny. But when they're doing millions of these transactions with millions of customers, it soon adds up to a pretty profitable business model. Okay, so how does any of this help us make better trades? Well, market makers are on the other side of every single transaction. If we could see where they are most active, we could see where the real orders are taking place. And this is the importance of being aware of the two biggest players. Dealing desks are the biggest customers. If we can see where they're trading, we can see where the real orders are. Market makers are on the other side of dealing desk trades. So if we can see where they're active, we can again see where the real orders are. So by looking at dealing desks and market makers, we've got two chances of identifying the real orders and the best moves. We've effectively doubled our chances of finding the most profitable opportunities. Just as dealing desk activity leaves behind telltale patterns for us to follow, so does market maker activity. And the first thing that I want to look at is liquidity. Liquidity is the word we use to describe the depth and size of a market. And in layman's terms, it means how much supply is there compared to demand. Are market makers willing to deal in the quantity that you want at the price that you want? And here's an example. You want to buy 1 million euros. Market makers are offering to sell 5 million at this price, 5 million at the price above it, another 4 million just above that, maybe 3 million above that, and so on. That is a highly liquid market. Market makers are supplying far more than is being demanded from you as a customer. You're going to be able to fill your trade at the price you want in full. You can trade quickly and easily. If, on the other hand, you wanted to buy 1 million and market makers were only offering to sell 500,000 at this price, and then there was nothing on the next two price levels above that, and maybe 100,000 at the next price level, and then another gap, and maybe another market maker was offering to sell 200,000 at that level, and so on. Well, that's an illiquid market. Demand from customers exceeds the supply on offer from market makers. You would struggle to trade your full 1 million. You definitely wouldn't get it at the price you wanted. You'd end up having to split your trade into smaller chunks and pay progressively higher prices. In a market with lots of liquidity, it's easy to trade, whereas in a market with low liquidity, it's much more difficult. You can see that liquidity is really just a reflection of how active market makers are, and you can probably already guess how that can help us trade more profitably. Market makers respond to the demand from customers. So let's say it's a really quiet day, no one's trading. Market makers will still let you know that they're willing to deal if anyone's interested, so they will place a basic bid and an offer quote. It'll just be something small, let's say 1 million on each side. Now, there are lots of market makers, there's not just one, and they all compete for our business. We're the customers, but they're not going to compete if there are no customers. And right now there are no customers. So just imagine the market maker is sat back, they're all chilling out. But then customers do start coming in. People start to trade, and the market makers suddenly sit up and begin responding to that increase in demand from customers. Initially, there are only a few customers trying to trade small amounts, but gradually more and more traders come in and are trading larger and larger amounts. Well, now the market makers are actively competing against each other to trade with us. So they become more competitive with the prices that they're willing to buy and sell at, quoting better prices and trading bigger quantities at each level. They may have started off in a quiet market only willing to deal $1 million at each level, but now they're willing to do 3 or 4 million at multiple different levels. They're basically trying to cash in on the sudden influx of customers. And what you've got there is one of the telltale patterns that market makers leave to show us where the real orders are. If there were no customers trading, market makers aren't going to be doing anything, and there's going to be no liquidity, or it's going to be very low. If there are lots of customers trading, market makers are going to be very active trading with them, and liquidity will be high. The more customers making real orders, the more liquidity there's going to be. Market makers always respond to customer demand. Customers act first, market makers react. So let's take a look at the dashboard and see what liquidity information it gives us. We've actually got two different measures of it. As you'd expect, we can measure it as it applies to each individual currency, very much like the calculations that we went through in the last lesson to obtain the individual currency strengths. That's what we're doing more or less the same way for assessing the liquidity on each currency as well. And that's what this section is dealing with. You can see we've got three columns above each of the currency symbols, and these tell us the relative levels of liquidity over three different time periods. The left-hand column tells us the average liquidity per minute for the financial session that is open at the moment. So let's say you're trading during the London market day. This will tell you the average liquidity since the London banks opened for business. Likewise, it would do the same if it was New York that you were trading. There's two things that this is useful for. The first is a direct comparison of one currency against the others. If this column is bigger on the euro than it is on the British pound, it means there's more liquidity on the euro than on the British pound. And remember that more liquidity means more real order activity. So straight away, you can get an idea of which currencies are being traded more heavily or have more customers on them than others. Now, what you do have to remember, though, is that certain currencies will always have more liquidity than others. The US dollar is far more actively traded than the New Zealand dollar. So you will always see the US dollar column bigger than the New Zealand dollar because the US dollar is far more liquid than the New Zealand dollar. Typically, you've got the euro, US dollar, and the pound and the yen. They're always bigger than the others, and usually it's the euro and the US dollar are the biggest of all. So you have got to get used to what is normal and appreciate that it's not quite as simple as finding the biggest column. Everything in the market is relative. But where this direct comparison between currencies becomes useful is when something is out of place or different to what normally appears. For example, you'll get used to seeing that the Canadian dollar is usually much smaller than some of the other currencies. But some days that does change. Some days the Canadian dollar is perhaps the second or the third biggest. And that's really unusual. It means the Canadian dollar is being traded way more than normal and possibly more than some of the bigger currencies like the pound or the yen. In that case, that's a really strong signal to take notice of that currency. Or if the US dollar drops from being the biggest to being somewhere in the middle, that's again a really important signal that something unusual is happening. Perhaps you need to avoid that currency today. Now, don't worry about that for now. That's one of the more subtle patterns to look for, and we'll come to that with time. The more obvious and the easier used pattern is the comparison of the next two columns in the individual currency itself. The middle column is telling you the average liquidity per minute over an intermediate time period, and the right-hand column tells you the average liquidity per minute over a shorter time period. For example, you could have these set to look at the last 1 hour and the last 10 minutes, or the last 10 minutes and the last 60 seconds. It's up to you. And this is where it's really useful. You can compare the liquidity right now or over a recent past against the session in total. That left-hand column basically acts as a benchmark, and it tells us what liquidity has been like on average today. And the other two columns measured against that let us know if liquidity is increasing or decreasing. If you see this pattern, which looks like an ascending staircase, it means liquidity is progressively increasing and is currently much higher than average. And if liquidity is increasing, it means market makers are becoming more active, and they only become more active in response to demand from more customers. Therefore, this is a pattern that tells us that more customers with more real orders are active on that currency. On the other hand, though, if you see a pattern like this, which looks like a descending staircase, it means the liquidity is progressively dropping off and is currently below average. If liquidity is dropping, it means there's a fall in customers placing real orders. So imagine two currencies side by side on a real day. Which one has got the better conditions that will give you a better trade? Now, it's not always as obvious as that or as contrasting. Sometimes all of the currencies are seeing the liquidity increase on them at the same time, but some will still be better than others, and you can make better trading decisions. Look at the pound and the US dollar here. Which do you think looks better? Look how much bigger the middle and right columns are on the British pound. Compare that to the left-hand benchmark average. The increase is significantly more. The middle column is double the size, which means the last hour has on average had twice as much liquidity, and the right-hand column is over 3 times bigger, which means the past 60 seconds has had triple the level of liquidity compared to the average for today. The US dollar is seeing an increase, but it's nowhere near as good as the British pound. Can you see how useful this information is? You're using liquidity levels to track market maker activity, and by tracking that, you're tracking customer demand and getting an insight into where the real orders are being submitted. This is another angle to assess where the real moves and which ones are perhaps ghost moves, something that's impossible to recognize if you're just looking at a price chart by itself. Now, the second measure of liquidity that we have applies to the whole market, not the individual currencies. This tells us what the liquidity across the entire market is like today compared to an average day. So imagine you normally trade during the London morning like I do. Wouldn't it be nice to know what today's London liquidity is like compared to the average over the past month? Are we above average or are we below it? And if so, by how much? That's what this tells us. And it is invaluable, either as a confirmation to get into good trades or as a filter to keep you out of bad conditions. One of the things that we haven't discussed is how liquidity impacts volatility. Volatility is the tendency for price to change direction unexpectedly and quite violently. You probably call it whipsawing, where the price whips up and down, and it's notorious for getting stop losses hit and knocking you out of your trades. Well, those choppy conditions are much more likely in markets with low liquidity. The mechanics behind it are too complicated to teach in an introduction course like this, so I'm not going to go down that rabbit hole today. Just take my word for it for now, though, that low liquidity markets create much riskier conditions for traders, and ideally, they should be avoided. We'll actually touch on that a little bit in the next lesson. And once again, that's something you can't see on a price chart. When a new market opens, like London or New York, you've got no idea how busy or quiet it is from looking at a chart, but with this indicator, you can instantly see it right from the beginning. Green means it's above average and red means it's below average. And this will update every second of the day, just like every other aspect of the dashboard. So you can see how conditions change as time goes on. Did the market start quiet and later on improve, or did it get off to a good start and now it's quietening down? Can you see how that can help you make decisions that adjust as the market changes? You can make decisions that are relevant to the ebb and flow of the market, rather than just one size fits all approach that most chart traders have to suffer with. If this is predominantly green, that's good confirmation that market makers are very active, and they're only active if customers are very active. So that's a good confirmation to trade. But if this was a wall of red and significantly below average, it means market makers are not as active as normal. And the only reason for that is if there aren't as many customers trading as normal. And remember, the customers are primarily bank dealing desks. If they're not trading, or at least they're not very active, do we really want to be? A low liquid market is not a good market to be involved in. I can't tell you the number of times this has kept me out of bad conditions and saved me from losing trades. Liquidity, either on an individual currency basis or across the market as a whole, is a very effective and reliable method of tracking one of the biggest market participants whose activity indirectly alerts us to where the real order flows are taking place. And if we pay attention to that, it will help keep us on the right side of the best conditions. In the next lesson, I am going to go into more detail about how to combine all of this information. I'll show you how to use currency strength and weakness in combination with liquidity, and we'll talk about how the two complement each other to signal the best conditions. I'm sure you've been wondering how that works and wanting some examples of how each section of the dashboard or analysis fits in with everything else to really give us the true picture of the conditions. Don't worry, we will cover all of that in detail in dedicated lessons still to come in the course. What I've been trying to do for now in these first few lessons is show you the primary dominating components so you understand them in isolation. That way, when we get to the point of putting all the pieces together, everything will make more sense and it's going to feel more natural for you. So if you have got questions, don't worry, they will be answered in the next several lessons. But staying on this topic, there's one more element of the market maker behavior that we can track, and that is tick volume. A tick, just to clarify, is any time the price changes in any direction. So if the price is 100 and it goes up to 101 and then back down to 100 and then back up to 101, that's 3 ticks because the price changed 3 times. Now, obviously, we have 2 prices on a chart, the bid and the offer provided by market makers, and those prices are independent. Although they tend to stay pretty close to each other, they do actually move independently. And We count the ticks when the bid goes up or down and when the offer goes up or down. So even though the price may only move 5 pips over, let's say, 5 minutes, there may have been thousands of ticks because the price kept fluctuating back and forth. Counting all of those price changes and adding them together gives us tick volume. Now, tick volume is different from customer order volumes. Customer order volumes show you the actual size of the orders that have been transacted at each price level. It's showing you the actual deal that has taken place. For example, you'd be able to see that the last transaction that happened was for, let's say, $2 million. The core volumes indicator is the tool that we use for looking at customer transaction sizes. Market maker liquidity volumes tell us the pending orders available to trade at the bid and the offer and behind the market at different levels. It tells us what can be transacted, but not necessarily what has been transacted. If the offer is for 2 million at this price and that changes to 500,000 at a slightly higher price, we don't actually know if that's because someone just exchanged money and a deal was done, or if the market maker simply changed their mind about how they were willing to offer and at what price. Remember that the majority of price changes in Forex are ghost moves that result from triangular equilibrium and not actual transactions. So tick volume is not transaction size volume. A tick is simply a change in price for any reason. It may not sound like it's much use, but actually it is. Prices will change if someone somewhere is buying or selling and changing the value of one or more currencies. We already know that if real orders change the price on one pair, all of the other pairs will also be adjusted thanks to triangular equilibrium. So we are going to get ticks counted everywhere. But once again, think about where the highest volume of price changes and therefore ticks are going to be occurring. It's going to be on the currency that is having real order transactions. If the real orders are on the pound US dollar pair, this is where market makers are going to be most active. There will be lots of them competing to trade with the customers that are over there. There are also more customers or real orders over there. And between those two major groups of participants, there are going to be a lot of price changes or ticks because it's a busy, active market. The currencies or the pairs that are being pushed around elsewhere in the market will have price changes and therefore they will have tick volume, but it's going to be less. Think about the extreme example that I gave you in the last lesson where we imagined there were only 3 currencies in the market and the real orders were happening between the pound and the US dollar. In that very exaggerated situation, the euro remained flat and unchanged. It was being pushed down by the strengthening pound and pushed up by the weakening US dollar, and the net result for the euro was it didn't change at all. And you would see the same sort of effect with regards to price changes and tick volumes. The euro is involved in the triangular equilibrium, but with equal pressure being applied from both sides, it wouldn't actually have a price change at all. Whereas the two currencies with real orders would experience a lot of price changes and tick volume. And I know that's a really extreme and completely over-exaggerated example that's unrealistic for the real market, but hopefully you can see the point. The currencies that do not have real orders taking place on them will not experience as many price changes as those that do have real transactions. And the further away from the action they are, the less they're going to be effective. And that's why tick volume is still useful for it. It's another indicator that helps reveal where the real order activity is. The tick section works in exactly the same way as the liquidity section that I've already explained. You'll notice that on here we've got red and green bars inside the columns of this section. Those are showing us the bid and the offer imbalances, and we're going to be talking about that separately in another lesson. So we can turn those off for now and hide them. All I want to talk about in this lesson is the basic tick volume. The left-hand column is the average number of ticks per minute for this specific market session being traded, and then the middle and the right columns are averages over 2 other time periods, such as the last hour or the last 10 minutes or 60 seconds. Again, it's up to you. The patterns you look for here are exactly the same as we discussed with the liquidity. An ascending staircase like this shows you that tick volume is increasing. A descending staircase pattern like this means that tick volume is decreasing. And I don't think I need to spend too long on this because it is just a repeat of the liquidity discussion in terms of patterns. The patterns are the same, and the way you interpret those patterns and what they mean are the same. The currencies with the most order activity will have the most tick volume, and therefore that's another tool that we can use to track where the real orders are and the best conditions are for us to get involved in. And we've even got the ability to do a little bit more in depth with this by switching to the second page of the dashboard. And this is which gives us a more detailed breakdown of that tick activity by currency and by pair. So for starters, you can see which pair is attracting the highest tick volume. If we use the example from yesterday with the euro and the Canadian dollar, when we looked at the strength lines, those two currencies really stood out as the two best in the market. And if we look at the tick volume for that pair, we can see it registered 6.65%. That's the highest share out of all 28 pairs. But look at the euro US dollar. That was also a good pair looking at just the strength and weakness, but look at the tick volume for it. Almost exactly half of what was registered on the euro Canadian dollar. That tells you a lot about which pair had the highest number of real orders driving the market moves. And if you compare the charts, the euro US dollar trended down around 70 pips, whereas the euro Canadian dollar was nearly double that with over 120 pips. And then over here, we can see the breakdown of each currency as a group, and we can see how the tick volume for the individual currency is distributed across the pairs that it's involved in. So looking at the Canadian dollar during yesterday's trend, over a quarter of its total tick volume was accumulated in its pairing against the euro. There's 7 pairs and 25% was concentrated on just one of them. The euro was nearly as impressive, with almost 23% concentrated against the Canadian dollar. And compare that to the US dollar at only 11.3. If you were trading or considering trading the euro, which you would have been because it was so obvious, how do you decide whether to match it against the US dollar or the Canadian dollar? Well, this certainly helps. If you can see that there is twice as much tick volume concentrated on the Canadian dollar compared to the US dollar, there's a big clue as to where the greater volume of real orders are being transacted, and therefore what the higher probability condition would be. There's a huge amount of information here, isn't there? It's not just about strength and weakness. You've got tons of extra pieces of information you can use to stack the odds increasingly in your favor to make better and more profitable trades. And I'm hoping that as each lesson in this course builds on the previous one, you're now beginning to see how powerful this can be for you. And I'm hoping that it's starting to make more sense. And of course, we haven't even looked at the core volumes and the bid and ask indicators yet. I know there's a lot to take in, and we've been throwing a lot of information at you, and so far you haven't been shown how to put it all together and use it for trading. So it might still feel like you're not quite sure how you're going to use any of this to actually make money. The next 3 lessons should clear all of that up for you. For now though, let's just quickly summarize what we've covered today and what the main takeaway points are. Liquidity and tick volumes will increase or decrease as market makers become more or less active and competitive with the bids and the offer prices that they're quoting. And market makers respond to customer demand. They're quiet when there are not many traders wanting to trade, and they become more active when there are more traders asking to execute orders. So the liquidity and the tick volumes give us telltale patterns of where market makers are most active and how they're behaving. It's a very similar process to how strength and weakness reveals where dealing desks are most active. And therefore, by tracking the patterns in liquidity and tick volumes, we can identify where the real order moves are taking place in the market, which will help us get into the best and most profitable trades. It's all just another process to add to our edge and give us an advantage over other traders. Okay then, that's it for this lesson, but let me just repeat my usual closing statement. Please rewatch this lesson. In fact, at this stage, I would recommend rewatching all 3 so far so that you can really tie all the information together and make more sense of it and get a better feel for how it relates to each other. A little bit of extra time spent now cementing your knowledge will pay dividends for you in the long term and help you make you a profitable trader far more quickly. Okay, that's us done here. I hope you've enjoyed this lesson. Please look out for the link to the next one tomorrow. Thank you.